Thanks for tuning into the Portfolio Manager. I'm your host, Neeraj Shah. Very special guest today, somebody from whom we take a lot of market insights, but their current new offering is underway. It's called the Carnelian Bharat Amritkaal Fund. And if indeed we're talking about an Amrit Kal, then it's spread over a really long time. And therefore, our guest today, Vikas Khemani, founder of Carnelian Capital, the questions to Vikas will be around what is the nature of a product like this? Because it does seem that you're building out a fund for the really long term.
Absolutely, Neeraj. I think if you see, specifically in the recent past, when you talk to clients, investors, most of them are worried about here, now, valuation, what do you think? And we said, when you zoom in, you're all the time worried about short term here, now. So we thought, let's build a perspective, zoom out and say what can happen in India over the next 20-25 years. Of course, India is in one of its best transformative journey. We have said this many times, and we genuinely believe that. So if India were to become a developed nation by 2047, what are the possibilities? And also more importantly, to examine whether it can become or not, and why it can become, right? And once you examine that, build conviction around that, and then look around what are the potential trends which will emerge, because every time an economic transitions or transforms, new trends emerge, new opportunities come about. So why not to tap into them, because those are the superior wealth creation opportunities. So our idea here is that, anchor investors from a really long-term perspective, because we have seen that when you look at 10, 20, 30 years, wealth creation is superior. You don't worry about, and we'll talk about more in detail, but so you don't worry about it. And secondly, show some of the possibility of the trends, and then tap those investment opportunities through this fund.
Wow. So, Vikas, how large is this fund in your eyes? And I'm presuming that, you in the past, all your strategies which have delivered some very healthy returns, you've had this India flavor to it, right? A big believer in the India story. So what layer does this add, or how different is this from what you have done traditionally in the past as well? What is the defining aspect of this fund?
So this fund basically, we have identified broad opportunity spaces, namely manufacturing, banking, financial services, consumption, infrastructure and services. Within those 5 broad spaces, what are the emerging opportunities, how we will tap into them, how large they can become, what are the companies which can sort of do that. So we'll tap into them. In some of our previous funds, we had slightly narrower focus. So like the shift strategy largely focuses only on manufacturing and technology, right? Which we launched in October 2020. So I think this is after long we're launching a fund which basically again anchoring towards creating wealth on a sustainable basis for next 10, 15, 20 years perspective. And we invest with that kind of mindset. Investment philosophy does not change. I think probably the lenses which you will look at some of the opportunities will kind of be very different.
Yeah, so your deck says about Amrit Kal, a period to regain India's lost glory begins. You cite 2047, that's 24, 25 years out. Yeah. What are the changes that you envisage in this period per se? And some of them might be short tenor in nature, yes. Some of them might be slightly long tenor. So what are the changes that you envisage, and how do you, or how does this fund propose to take advantage of these?
Right. So I'll tell you, see, we all know that India had one point in time quarter of a share of GDP, before foreign rules, right? Same with China, and during the British rule, we all lost to 2-3%. China started the journey 40 years ago and regained them. I think India has recently started. In last 8-10 years, a lot of work has been done. Foundational work has been done. We have had long pending economic reforms carried out. We had digital infrastructure getting built, physical infrastructure getting built. So a lot of foundational work has been done. And we do believe that now India has embarked on this journey of gaining the lost share in the world GDP. Today we are at around 3.7, 3.8%. This number can go to 15-16%. It means our GDP can go from 3.7% to almost $29-30 trillion by the time Amrit Kal ends. And whenever this kind of, almost like 90% of GDP is ahead of you, 80-90%, right? So this kind of growth happens, massive wealth creation happens. And it is important to know that why it is possible this time around. And I do believe that there are major tectonic shifts have happened in India, in the mindset of India, specifically in the recent past. And I classify them 6 tectonic shifts. Number 1, India has moved from incremental mindset to exponential mindset. No more we think we will take 10 years, 20 years to do things. we want to do here now with sense of urgency. Secondly, India has moved from constrained mindset to no constrained mindset. Meaning, we are always told that India is a poor country, we don't have money for defense, famous statement in parliament. No more the case. You are building world-class infrastructure, you are doing everything. We will figure out money for what it takes, but there are no constraints which are there mentally. Right? Thirdly, if you see historically, whenever India faced any problem, we look towards West for the solutions. UN, World Bank will come and preach us. No more the case. We are finding solutions to our own problem. World is still debating about universal basic income. We have implemented in the form of DBT, right? So that's the beauty of India right now. Fourth, India is innovating at a scale and a low cost, right? UPI, telecom. Nowhere in the world you will find less than $2 unlimited data, including China, by the way. So that's a very big change, big change happening in India. Fifth, if you see, historically, we've always believed socialism or capitalism. India has beautifully experimented social welfare and development can coexist. They are not at odds with each other. We have lifted 20 crore people out of poverty, which is a big deal. Right? And lastly, when it comes to the global stage, India no more sits at the corner. We all touch that, right? I mean, India is sitting at the center, driving the agenda and becoming, part. So I think all these three things will lead to broadly strength, scale and speed. We are the most populous nation on the planet. We are the youngest nation on the planet, and we are the most aspirational nation on the planet. So if you again see last 10, 20, 30 years, any company which has created massive wealth, you will find three common things in that: strength, scale and speed. That is happening at the country level. So this is what we believe, that we are going to see at a country level massive transformative wealth creation opportunity, because we are seeing strength, scale and speed. And that's the key thesis behind this. And then look at some of the mega trends. Within those mega trends, what are the opportunities?
Okay. So, again, some of these points well noted, some of these points out there. For this fund, you are saying that these factors will lead to some emerging mega trends, and you will look to tap into those.
Yes.
Right? A lot of people will argue that India's valuations capture some of the positives that the India growth story promises. So are these mega trends or these emerging mega trends slightly different or hatke than what is currently mainstream? Can you help us understand?
Not necessarily. See, I'll tell you. Okay, let me give you an example. Let's take most common sector, banking and financial services, which is like, as it has been doing well, right, for last 20 years. So India's total credit in 2001 was $125 billion. Today it is $2.5 trillion. Almost 20x in last 20 years. Despite we have so many problems in the economy, banking system was not robust, we didn't have IBC, we didn't have. So as we move forward, this $2.5 trillion will grow to $65-70 trillion. So that kind of growth we'll see in the, now if you see last 20 years, in 2001, total market cap of banking financial services was $9 billion. Today it is $1 trillion. But more importantly, in 2001, we had only three segments: PSU banks, NBFC and private banks. FSI was hardly anything, less than 1%. Today, FSI in this $1 trillion is almost 18-19%. So the point is, every time an economy transitions, you have new segments coming out within the so-called banking and financial services segment. You didn't have wealth platforms, you didn't have mutual funds, you didn't have insurances as big. So as economy transitions in next 20-25 years, you will have many more such new opportunities coming out. It is our job to keep looking for those emerging opportunities and invest into them. Like MSME is one of the biggest or fastest growing segment, right? Which so far has grown, but not as fast. We think that it's going to grow significantly from here. Now, we need to tap that. Insurances will do very well, right? Insurance, I mean, as your per capita income grows, what do? You save more, you channelizes, you spend on different things which you earlier would not do from even savings perspective, right? You wouldn't buy insurance earlier, now you'll buy more insurance. So all those things will create massive opportunities, right? So the whole idea here of building the perspective is to first build perspective, and then we will keep tapping. It's not that you are building static portfolio which will remain for 25 years. You will keep attending to the opportunity, keeping in mind long-term trend, and yet the short-term risk reward of the opportunity as well.
Because there have to be some overarching or bedrocks under which some of these themes get developed, right? In the past, you've spoken about the growth in corporate profitability and how that is one bedrock. You've spoken to me personally about how if you look at, let's say, for example, what used to be the Achilles heel, which is current account deficits, etc., changing now, and that good macro also helping businesses flourish and thrive. Can you talk a bit about that before we talk about some themes?
Sure. So I think, see, if you see total corporate profitability of India today is $150 billion. In 2001, it was $8 billion. So in last 20 years, 2001, so it's last 20 years, we've kind of almost 20x, right? This $150 billion, according to me, by 2035 will become almost $1 trillion, and 47, $2.5 trillion. Let's stay at 2035. So if we are almost 6.5x of profits we are talking about, it means our market cap can become $18 to $20 trillion by then. Even if I take 1820 P. Today we are at $4.5 trillion. So at a market level, we will see significant wealth creation opportunities. And if you have a little bit of more alpha, you can make 6x, 7x returns at a portfolio level. That's the kind of opportunity India is sort of presenting. And interesting part is that this time around, the typical fault lines of India are not there. Historically, if you see, only 5 fault lines have been in India: current account deficit, fiscal deficit, banking system, health, inflation, and your debt to GDP. If you see on each of this, our current account deficit is sorted. We are more moving towards current account surplus. Fiscal, we are one of the best managed in the world. Tax collections are robust. Inflation, we have managed so well. Our banking system is robust, squeaky clean, and well, set for growth. And our debt to GDP is one of the lowest in the world. And we are the only country which has reduced debt to GDP since global financial crisis. So the whole leverage cycle is ahead of us. So your fault lines are not there. Your vital statistics of your body is there in place, so you are ready to grow. Now, when I am saying, it's not that it's going to go one way, there will be ups and downs.
Course.
But the thing is that you can today invest with a lot of peace because your underlying strength of the economy is very high, and then you can spot those emerging trends which you can invest into them.
Okay. Can I play the devil's advocate for
Yes,
some
please.
things? So, for example, let's say banking and financial services. So, a lot of people are very constructive on the non-banking side, maybe the non-lending businesses as well, insurance, etc. For banking, the critique that I hear, for example, and maybe it's a near-term critique, but the critique that I hear is that on the deposit side, banks will have to do a lot more in terms of higher cost deposits. It's no longer what used to be, wherein deposits were there to be taken. There are other avenues out there. And on the borrowing side, borrowers have a lot more avenues behind bank credit, and therefore bank credit being the proxy to the capex story need not be the place. So why play banks, for example? Why not look at other things? How would you?
So I'm saying, my point is that you talk about total BFSI.
Yes.
You don't have to necessarily talk banks. While I think I'm positive on the banks, like banks is not necessarily only the credit to the capex. Today we are talking about MSME credit, we are talking about personal loans, we are talking about mortgage. So banks are catering to a very wide variety of services. In fact, banks are also doing a large part of services on the wealth management side, and I mean it's kind of fairly wide gamut. It's not small, right? So the bigger point is that as long as economy is growing, savings are growing, you'll have that much thing needs to be more channelized, and if you see today your savings pool is about whatever that number you can take at your GDP, about let's say 25% number, $1 trillion.
Sure.
If your GDP is going towards let's say $10 trillion, that number of $1 trillion will become $2.5, $3 trillion.
Sure.
Right.
Sure.
And so that much more will have to be channelized through the same channel. So it means more volume, more and same thing has happened in the last 20 years. So what I'm saying is not new. It is going to happen a lot more efficiently, a lot more better, is what the point is. So your idea is to keep looking for, there will be short-term challenges. I mean, short-term ups and downs will always be there. Sometimes deposit challenges will be there. Those you navigate.
Okay.
But they should not come in your overall view of the long-term structural opportunity.
Okay. The other aspect is 2 points that you mentioned in your this thing as well, which is office to the world and factory to the world. Now, office to the world, you can very well see as well that's happening. Are there challenges to the factory to the world argument?
Not really. I mean, we've been one of the biggest believer in this, and I think this is only beginning. See, today our manufacturing GDP is only $0.6 trillion. This number will become $8 trillion, 16x from here, twice of our current GDP. And
what gives you the confidence?
Because I think,
we've historically lost out, right?
No, but I mean, if you look at the last 3-4 years, we've been gaining, right? Entire manufacturing sector is growing. I mean, largely 3-4 reasons. One is, of course, government's focus to imports, substitute imports. encourage exports. But more importantly, our cost competitiveness vis-a-vis China has improved. You know, the world, because of geopolitical, China plus one is playing out very well. Most of our companies we invest or are telling us that the demand is very, very robust. It is we have to get the capacity up and ready and, you know, deliver. So demand profile has changed, right? And today we know that how the world is setting up capacities here, Apple, Samsung, both for domestic as well as export market. So once the ecosystem builds, you know, it finds its own life. And I do believe that we have one of the best manufacturing cycle ahead of us.
Okay, and one thing we have to admit, Vikas, which is that Indian infrastructure now is a lot more formidable than what it used to be. So one, it's a facilitator. Two, is that an opportunity as well?
Absolutely. I mean, see, you know, infrastructure always has a multiplier effect, right? I mean, John F. Kennedy had once said that America is, you know, American roads are not good because America is rich. America is rich because American roads are good.
Exactly.
So, you know, infrastructure has its own multiplier effect on the economy. And, you know, if you see here, India is going to spend huge amount of money. 40% of GDP India is spending only on railways. In US, when they did during the railroads time, it was only 30% of GDP, and they had a massive, you know, rally or economic growth post that period. So India is spending on roads, rails, ports, airports, you know, metros, everything India is spending. So it will have apart from ease of business and ease of living, multiplier impact on the economy. And that is what we have seen in Germany happening. We have seen in many parts of the world happening.
Yeah. Yeah, but in India's case, post-2008, infrastructure used to be a taboo word. You think from an investing perspective, investing into infrastructure, you think that's changed?
Yeah, it is changed. Ultimately, it's all about governance, right? I mean, there was a time, today we have, because of use of technology, lots of policy change, I think governance frameworks have changed. That's the reason if you see, you know, EPC companies have been doing well, you know, I mean, lots of things have been fixed, right? And still, I'm sure there'll be challenges. You got to be careful, never say that everything is fine. So, you know, your whole fundamental bottom-up risk reward you have to do. I'm not saying that. The perspective is that opportunity is large, but you got to figure out your risk reward of individual opportunities. So if it is not there, we will not invest. You know, in some of the, let's say, setup. There might be some setups where risk reward is not favor, clarity is not there. So that part should not be lost ever.
Got it. Okay. I have two final questions. One is again on a theme, and then one is the overarching view again. That's what we end with. The last question will be on the book on the table and what you learn from all of these things and apply to something like this. But before that, consumption. India has traditionally been that consumption hub, right? The joke used to be that foreign companies are coming to India not for the great roads, but for the consumer. Do you think that while now that argument can be challenged, but the Indian consumer story still stays? And is it different than the past? Past used to be staples, premiumization was never a case in point. Is that changed now?
No, I mean, it will only change. I mean, as if you see, as your per capita income goes towards from $2,500, $2,600 to $18,000 over the next 20, 25 years, people will consume. See, your household income, the graph, basically bottom is shrinking and top is sort of broadening. So as this happens, right, you know, each of this category of your households, you know, will consume more new, better. As you upgrade your life, you consume more new, better, right? And that means what? That means, you know, you will move from staples to, you know, premiumization, durables, or, you know, discretionaries, and you will spend a lot more on travel, tour. Lots of new opportunities will come which today don't exist. Luxury India has not even started. According to me, you know, there's a huge play for luxury over the next 10, 20, 30 years, and we will see that those coming about, right? Because we are a very aspirational society.
Yeah, sure.
And, you know, we don't mind spending. So it is change. It is changing already, by the way. The way today youth is spending, I don't think we were spending when we were young. Right, so that is changing, and it will change further. But our under penetration on everything is so steep, is so low that we have a long, long way to go.
Okay, because one final question, and that is maybe pertaining to all kinds of investments that you do in across funds, but specifically for this as well, because this is long-term in nature. From whatever little I have understood of you, you take multiple kinds of bets. Some are, let's say, aspirational 1 to 100. 100x ho jayega. Some might be 1 to 10, and some might be this stability that, okay, I'm not taking them for the 1 to 10 or 1 to 100, but they will provide that every year CAGR, etc. Right? At the current juncture, for a fund like this, which promises to be large scale in nature, I believe your ambitions would be high here. How do you position the portfolio in something like this? Do you take those large bets which could be jokers, which could give you 1 to 100x? Jokers might be a wrong term, but 1 to 100x. Or do you go for stability in the current macro environment?
No, I think, see, when you invest, so in this though, we are thinking, planning is a flexi cap fund, and there will be a combination of companies which can have valuation re-rating and accelerated growth. What we call in our parlance magic basket stories, where you can get combination of both. So you have to catch trend a little early and stay invested into them. So we have, though we will have those kind of names as well. But 70 to 80% of the fund will be concentrated into 2022 names, and we will have a long tail of 8-10 stocks which can potentially be multi-baggers, so to say, in fullness of time. So which can create significant alpha as well. So our idea is to, fundamental bottom-up risk reward quality growth at a reasonable price. That doesn't change. Of course, we will never bet on a company where the corporate governance issues are there. The crooks is something we never bet on, and we're very careful about that. So that's the only no-go area we will have. So we will carefully pick up companies run by great management in the middle of a mega theme, and where the risk reward is in your favor. And we hope that and if you do that basic right, like in all our funds in the past, we have had great performance. So I'm hoping that we are able to replicate that in times to come.
Well, may you do even better than that, because leave us with one key aspect that you've learned from, let's say I see that you're reading this, you keep on reading, right, Poor Charlie's Almanac or some others. Leave us with one key aspect that you gather from your readings of such books, which you apply to the investment philosophy of yours.
Simple. I think my favorite dialogue by a statement from Mr. Munger is invert, always invert. Tell me where I'm going to die, I won't go there. So we are always constantly looking for where the risk can come from, and where we can kind of lose capital. So our biggest focus is that we should never lose capital. We should never have permanent loss of capital, and largely the source of that is broadly only twofold. Either you bet on inferior quality of the management, or you bet on a business which is prone to disruption. So these are the two things we are focused, that we hope that we never have in our portfolio, and we are like hawk-eye we have on this kind of thing. So, and if you avoid major mistakes, your outcomes are going to be by and large okay. So we are generally, I think, if you are slightly above average and avoid mistakes, combination of these two things will take you far. Okay,
great. Vikas, such a pleasure talking to you. Thanks for taking the time out, and all the best from all of us here at NDTV Profit for the Amrit Kal Fund.
Thank you, Neeraj. Lovely talking to you as always.
Yeah, as always, lovely having you. And viewers, I hope you enjoyed this conversation as much as I enjoyed doing it. Thanks for tuning into the Portfolio Manager.